So we're good.
All right. Hey, everybody. Welcome to our discussion Wednesday, August the 12th. It's, of course, 9 o'clock. Leon now are coming to you from Investing Education Academy. Some of you all will be watching us live. Many of you all will be listening to the podcast. Now, today we picked a topic we thought was really important because there's a lot to know about it, and it's about growth investing. So I'm going to let Leon tell you why we chose this.
Yeah, so Brent and I often get questions, and just in general discussions. Oftentimes people want to know why we pick a particular stock, particular industry, and kind of what's the reason behind it. And one of the biggest reasons is Brent and I. So they're really two types of investors. 99.9% of the time, either a value investor or a growth investor. So last week, we covered value investing. So if you want to learn about that, just check last week's video on YouTube, or if you're in part of our members network, it's inside IEA TV. That covered value investing. This week, we're going to cover the other side of that, which is growth investing. Now, growth investing is probably the one that most of us are familiar with. It's the stocks that all of us love. It's the Amazons, the Facebooks, it's the Amazon's, Facebooks, Microsofts, all the big names that we know, like the household names, Walmart, not Walmart, Home Depot, things like companies like that, companies that are growing either exponentially or growing at a rapid rate relative to the industry. So Brent, for one, Brent and I are two totally different type of investors. We're two totally different type of investors. I am a mix of value and growth. Brent is primarily a growth investor. He likes the more stocks that move more, that give a lot more volatility. With that, you get higher returns. I'm more risk averse. I like a little more mixed portfolio of value and growth. So Brent, you just throw up slide one. We'll kind of go through what growth is. What this slide is going to show you, it's going to define what growth investing is and kind of give some characteristics. And then we're going to have two examples at the bottom. And like I said, the reason we're doing this is because in our conversation we have with people, again, people are often wondering why we're picking a particular company. What's the reason behind it? Well, it's typically because we're looking for growth or we're looking for value. Like I said, Brent is 9 times out of 10 growth, but he does have value plays too. But the majority of his picks are growth, where mine are generally more of a mix. And usually I aim more for growth, but if I want to kind of balance my portfolio and bring down some of the volatility in my portfolio, I'll look for value investing, value stocks.
Also, too, another thing is we decided it was important because many of you all never learned this in school, right? I was a banking and finance major, and they glossed over stocks as if it were just one type of stock. Like there's one type of stock, and invest in it or you don't. And on the flip side, when we start learning about the stock market and we start hearing people throw around and have a growth-based portfolio, blah, 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 it sounds impressive. It's just the name of a type of investing strategy or a type of stock. And we're going to go through and actually describe what that is. And for those of you all who sometimes mix up, value investing versus growth investing, just understand we're going to focus on growth investing today.
Right. And if you want to know about value investing, like I said, we covered that last week. So if you want to check last week's video, you can find out about it there. So what this chart we have up on the screen now is going to define what growth investing is, growth investing is in growth stocks. And then, like I said, at the bottom, we're going to go over two examples. But just to give a definition, so generally growth investing are companies that increase their sales and or earnings faster than the average business in their industry or the market as a whole. So, I mean, all that really means is if you have a market like, say, retail, and let's say on average, retail sales by most companies grows at, say, 20% a year. But if you have a company in there, let's say like a Home Depot or a Walmart, and these aren't concrete examples. These are just examples I'm pulling out the air. If you have, say, a Walmart that grows say the industry grows at like 20%, but then you have like a Home Depot that grows at 30 or 40%, that would be considered a growth company because it's outgrowing its industry. Also, you can also use the metrics of the S&P 500. So the S&P 500 is what we consider to be the market. So sometimes it can be hard to find industry-specific data on some of these metrics, and it's a lot easier to find the S&P 500. So if you want to look at the S&P 500's annual sales rate, if you find one that's say 20%, again, if you find another company that's growing at 30, 40%, that would be considered a growth company because again, it's growing sales and or profits faster than the industry and or the market in general.
And when you're looking at growth stocks, understand that they come in and out of season, right? It's not as if a company comes out and now Amazon is a growth company and they're a growth company forever. That's not the way it works. Also, if any of you are, watching and listening to us on the podcast, and you're thinking, oh, well, I have a growth mutual fund, are all the underlyings, which are actually stocks inside of the mutual fund, are they all the same companies all the time? And the answer is no. There are seasons for companies to be considered a growth company and seasons for them to be undervalued, season for them to be a value play. I mean, it depends on the season in the company, but it's not once a growth stock, always a growth stock.
Right. Yeah, definitely. Yeah. I mean, you have companies that were growth stocks in the 80s and 90s that don't even run. Some of them are out of business. Some of them are a shell of themselves. A good example, actually, just on current events. I don't know if any of y'all have been following Kodak, but Kodak, the company that used to do like film and pictures, that's kind of basically disappeared. They were almost like a penny stock up until I think a week or two ago, when they got a very dubious contract from the Trump administration to produce some sort of chemicals related to the COVID vaccine, I believe. And the stock went from almost nothing, and it actually went from, I think it was like either like $2 or $6, shot up in 3 days up to $60. So that's a company that back in the day, Kodak was a big company, a big camera company that basically went away. I mean, Kodak was no longer a growth company. Their stock was, lagging like around $5-6. And then only because of this dubious contract that it shot up to, 60. And I think that now it's back down to like 5 or something. So yeah, Brent said companies will come and go. They're not always going to remain growth stocks. Kodak is one example.
And also, when you hear a story like that, if you are an IA member, you heard us talk about pump and dumps inside the platform. And, I'm pretty sure that Kodak, even without looking at the charts, they had a really low market cap when, or number of shares that were in float during that time period. So really anything that happened to them can affect them drastically one direction or the other, right? So when a company like that exists, it's very easy for market manipulators, not naming any names, to go in and do what's called a pump, where they either release an article, they talk about the guidance on that particular stock, all of a sudden goes from a sell to a strong buy, like in a matter of a week. And then all of a sudden that, again, we talked about this yesterday, stocks are sometimes nothing more than popularity contests, or the value of stocks is based on the popularity at the time. There can be some level of market manipulation at times. And then when that happens, and you have these companies that explode, and then all of a sudden they're back down to nothing, that's a pump and dump.
Right.
It's this classic pump and dump, actually. The sad thing is it's not illegal. It's just that you should be aware of what you're buying. Again, goes back to always do your research.
Right. And we're going off on a tangent, but just to tie this up, it was a clear pump and dump because the stock actually jumped by like some high percentage the day before the deal was announced. So clearly people were in stock that knew the deal was coming, and then boom, it went from $2 or $5 to $60 in 3 days. So, but I say all that to say Kodak at one time was a growth company. As Brent said, not all companies remain growth companies, and Kodak was lagging, was around $5 for years. So it went from being a growth company to not.
But some people who aren't familiar with Kodak, another one would be Blockbuster.
Yeah, right. Yep. Netflix killed them. So Netflix came along and knocked it out the box. So that's another example. Okay, so back to the slide now. So we kind of get the definition of what they are. Growth stocks are companies that are growing sales and or earnings faster than the market in general or faster than the industry. Another characteristic, which is probably the most important, is that they have an innovative product or service that's in high demand. So think like Zoom, think Tesla, think what's another big, like think Apple, think what's the one, Brent? Teladoc Health?
Amazon.
Say what?
Amazon.
And well, yeah, I mean that's there, but I'm trying to get some other ones that aren't on the screen.
Teledoc is actually a really, I'll tell the story of Teledoc. And if you've been watching this, or if you're a member,
Brent, real quick, come closer to the mic. Yeah.
Okay, so if you're an IA member and or if you've just been with Leon and I from a few episodes back, we talked about Teledoc was like one of our early choices.
Yeah, yep.
And I want to say it's up over 20% since we chose it. So at least 20%. But anyway, that's like a classic growth stock. In the industry, Teledoc they provide virtual doctor services or engagements. And right now that's the hot thing, right? We're getting doctor's appointments and it's virtual. Like a lot of doctor's appointments are virtual now. Teledoc was on that path before COVID. We knew about the company about a year and a half ago, or a year ago, and we've been watching it. We actually picked it early. But when COVID hit, they exceeded the market. In the one thing is, I'll say when in regards to like having the consecutive quarters of profit, I don't know if they've achieved the profitability side because of the debt they had when they started the company. So I would need to see the financials, but they fit the mold of a growth company. Extreme acceleration, beating their particular industry or market sector. And now it looks like they're poised to continue that momentum for at least 2, 3, 4 years to come.
Yeah, so that was your so TDOC, the symbol is TDOC, TDOC. That was Brent's pick on April 29th. And since then it's up, it's coming out, it's up almost 6%. It was up a lot more than that. It's come down. I think it was up closer to like 20% at one point.
Yeah, I think it's 20 since I bought it.
Yeah. So since you picked it, it was up like 20, but now it's up 5. So, but that's another example of a growth company because so those are examples: Zoom, TDOC, Amazon, companies that have innovative products that are in high demand, and also are growing their sales and earnings at a rate that's greater than the industry or the market in general. So those are two key points. Now, the third one on here is another very important point, is that growth stocks tend to be more expensive than non-growth stocks or like value stocks. And last week we went over how to kind of judge when something's expensive or cheap relative to a stock, and we use the price to earnings ratio. And if you want to, we're not going to go into that tonight, but if you want to kind of figure out what the PE ratio is, again, go watch last week's. We went into some detail there. But just know that the concept behind a PE ratio is that you want stocks that have lower PE ratios relative to other stocks. So a company that has a PE ratio of 20 is cheaper than a stock that has a PE ratio of 50. So the lower the PE ratio, the cheaper the stock is. Tech stocks would generally, you'll find ones that have, PE ratios like 50, 60, 70, sometimes 100 or more. But the flip side of that is you're getting superior growth. So you're paying more for a stock, but you're paying more for that because you're getting superior growth. And as we all know in this world, nothing is free. So right. If a company's going to be growing at, if they're going to, some of these companies are growing their earnings and sales hundreds of % a quarter. So to get that kind of growth, you got to pay for it. So you're going to find stocks with PEs that are, again, 60, 70, 80, over 100. Just to give some relative information, the average PE of the S&P 500 right now is 25. So I'm talking about, again, tech stocks at PEs that are in the 50, 60, 70, sometimes over 100. So they can be really expensive. But again, you're getting that superior growth.
And also, if you have a PE, or if you're looking at companies with lower PEs because you think they're less volatile, be careful when you get to like 15 and below to know why it is at that price point, or why it's at that PE ratio. So there is a too low point where you should be concerned.
Right. And also, and conversely, if it gets too high, you should be concerned too.
Yep.
Because if a PE gets too high, because all PE is the price of the stock divided by its earnings. So if, as the PE really grows into the hundreds, that means the stock price is really, really expensive relative to the earnings it brings in. So it can get kind of dicey. But again, you'll find tech stocks, some of these high flyers, Zoom, and I'm not saying Zoom does, but stocks like that, Zoom and like TDOC, that have really high PEs can be in like the 70s, 80s, 90s. It's a gamble. It's a risk. If you're willing to take that risk and willing to pay that much for that growth, just know what you're getting into. But a lot of the growth stocks that we all love do have high PEs.
Yeah.
So 2 examples I have in here. are Amazon and a company called, I can never say this right, Mercado Libre. And I chose these two for two reasons. One, because they're both retail stocks. We all know Amazon. Amazon is the 800-pound gorilla, the biggest e-tailer on the planet. I mean, they run the world, as we know. And so what we see here is that Amazon, over the last 3 years, they've been growing their sales at 23%. Very solid, very good growth. Now, conversely, the S&P 500's sales have been growing at 6.4% over the same amount of time. So that tells you that Amazon is a growth company. They are a solid growth company. Now, their sales used to be a lot higher. I mean, Amazon has gotten really mature over the last 5 years. I mean, they were up in like the 50s, 60s, 70s at one point, but now it's down to 23. But even at 23, even growing sales at 22% relative to the S&P 500, that's still a growth company because it's what is that, 6 times? That's almost four times the growth. Amazon being 23%, S&P being 6.4%. So that's Amazon. So Mercado Libre, yeah. So Mercado Libre is a retailer in Latin America. So they're kind of like the up and coming Amazon in Latin America. Now look at their sales growth, right? Their sales grows almost 3 times Amazon's at 55% over the last 3 years. And the reason I chose these two is, one, because it's apples to apples. They're both retail. But the other reason is a lot of people watching this probably or listening to this probably never heard of Mercado Libre, right? Didn't know it existed. And that's kind of one of our missions at IEA is to bring forth companies that a lot of people don't know about. I mean, we all know about Amazon, Facebooks, and Teslas of the world, which are great growth companies. But there are growth companies like Mercado Libre that are growing significantly faster than a lot of those big names. As we see here, Mercado Libre is growing at almost 3 times faster than Amazon relative to sales. So, and another thought I had behind this was, Brent and I's mission now with IEA is to really address the return on investment gap, or what we've dubbed the ROI gap. And the reason that's kind of our focus relative to the wealth gap is because the wealth gap is kind of a catch-all. It has a whole bunch of stuff in there. I mean, it has to do with income, housing, return on investment, a whole bunch of stuff, right? We can't control housing, and we can't control how much money companies pay us, right? But we can control the investments. We can't control where we put our money and the returns we get, right? So that's why Brent and I are really focusing on the ROI gap, which then in turn, help shrink the wealth gap. So we want to bring forth companies like Mercado Libre that are growing significantly faster than the market and significantly faster than the general public. The general public are investing in, because think about it. If all we did was invest in the same companies that the rest of America is, we'll never shrink the ROI gap, because we're doing the same thing. So in order to beat the ROI gap, we need to invest in things that are giving us higher returns. So a company like Mercado Libre are the type of companies that at IEA that we're really trying to bring our community so that we can shrink that wealth gap that we identified that's actually that white America on average earns 139% more on their money than Black America.
And so that also just getting everything above and beyond our savings, our critical savings, out of the savings accounts. And I know we think we're saving money in savings accounts. You're losing and throwing away money every day. Your money is in the savings account. And to the point Leon made, the two things we're really focusing on to kind of narrowing that wealth gap, number one being the ROI gap, addressing that, we can address it. And then also the financial literacy gap, because we received emails and texts and so forth last week alone of people saying they never knew what a stock split was. I mean, that has nothing to do with even where you're investing in, but they just didn't even know. They weren't financially literate to know that these things happen. And so we're understanding the financial literacy gap is huge. And that's why we're talking about what a growth stock looks like. We're giving you the education on it. And then we're also talking about the ROI gap by saying, look, these are companies that can help level the playing field. So it is definitely our mission to narrow the wealth gap in America, and we're going to do our part, which is honestly why even our membership, for those of you all who are members, we have membership platforms that you is more than 2 drinks at a bar. I mean, it's less than 2 drinks at a bar.
Right. Yeah. And so Mercado Libre are the type of companies that we're really trying to bring our community to like I said, shrink the ROI gap by showing investments that have greater return than the general market. Okay, so what we're looking at here now is a graph. It's a percent change graph. So it's showing the return over the last 3 years of Amazon versus Mercado Libre. And because remember, what we showed before was the sales growth of the two companies, how Mercado Libre was almost 3 times the sales growth of Amazon. But of course, that doesn't affect our money. We want to know how can we make money in this. So this is a percent change of the stocks over the last 3 years. And what we're seeing is at the bottom is Amazon has grown 220% over the last 3 years, whereas Mercado Libre has grown at 360% over the last 3 years. It's 140% greater return for Mercado Libre than Amazon over the last 3 years. Now, again, the ROI gap, white America on average earns 139% more on their money than Black America. This is one way to shrink something like that. To get a return, we're getting 140% more from a stock with something like Mercado Libre than you would at Amazon. This is how we shrink that gap. Not saying only buy Mercado Libre. I mean, buy Amazon too. But we also want to have our community in investments like Mercado Libre that are returning 140% more than something like Amazon.
And really, what we're saying is do your research to see if it makes sense for your portfolio. We're not just saying blindly go buy Mercado Libre or Amazon. We're saying do your research, make sure it makes sense for you. And again, once you go look up the stock prices, don't forget there are fractional shares. For some of you all who believe, one of the price points may be out of your league, there are fractional shares. This is why fractional shares exist. You don't have to wait for a stock split. A stock split means fundamentally nothing. And so, we're not going to go down that road because Leon and I pontificated about that yesterday. But, we just want you to understand, do your research, make sure it makes sense. And we're not necessarily saying just go buy it and go buy Amazon. We're saying make sure it makes sense.
Right. The whole point of this is, these are not stock recommendations. All these are showing the degree to which you have different levels of growth stocks and the difference in their returns. Mercado Libre and Amazon are just 2 examples showing the difference. But also, again, we want to expose our community to something like Mercado Libre that's growing at 140% more than Amazon to let them know, hey, it's out there. Like Brent said, if it works for you, go ahead and buy it. But in order for us to shrink that ROI gap, we've got to have our money in things that are not like bank accounts, savings accounts, bonds. Need to be in stocks that are growing significantly more than the market.
Yeah, and if you all are engaging, like right now, you're coming into a lot of you all. Whenever there's financial unrest or uncertainty, many people go to their financial advisors. We're not knocking anything financial advisors do. My past life, I was a financial advisor, and I get their need to be conservative in how they approach their clients, which might be somebody listening to this. Again, if you're listening to the podcast, if you're watching this live and you're thinking, I just met with my advisor or I was planning on meeting with them, just be wary when they try to go all bonds or all CDs because they think the market's falling out or the bottom's falling out. We've done several discussions on what the bottom looks like in the market, and it's still 9% higher than what you're looking at in banks. And that's just on that's on a bad day. I mean, we've had people who on our, if you're in our community, we had a conversation with Attorney Beverly Winstead when she did the hot seat, a stock that she bought because she saw a long line at Costco for toilet paper. She went and bought the stock, and I think it's up, what was it, like 35% or something?
Yeah, it's like 35-40%, yeah.
I would think it was 75, but I just don't want to say that out loud. But
it was that much? Okay.
30, no, it might be 30, it might be 25. Let's say 25 to be conservative. So anyway, it's up 25%, not just because she moved her money from a savings account to here, but she is now thinking differently. She moves through time and space, and she has the opportunity for investing, right? So many of you all thinking, well, if I didn't listen to this, how would I find out about a Mercado Libre? And some of you all are watching this thinking, I never even really thought to buy Amazon. Like, we're taking for granted. Some of you all may not have ever even thought about buying Amazon. So, okay, actually, Beverly just confirmed it's up 25%.
25%, okay.
And so, and she's had it for like 2 months.
Right. Yeah, just since COVID, because she went to the store and saw the lines and was like, gotta buy. Yeah.
So, I mean, the ability to get your money working for you, because each one of us is an employer. And anybody who's getting a check, not gonna say each, anybody who's getting a check from work, from their clients, or commission payout, government assistance, you're an employer and your dollars are your employees. What are you going to do? Are you going to put them to sleep? Are you going to put them on vacation? Or are you going to put them to work? And so it's very important that you understand you are an employer, and you should recognize if you're a bad employer, your employer is going to do bad work, and that's where you're putting your money. So just make sure you understand how you're moving, and we have to speak to mindset because this isn't common knowledge. And some of you have people to come out and they're the gurus, and they're like, yeah, you're seeing this because of us, aren't we great? We're like, no, look, we're trying to bring this research to actually move you to action. So if you're driving, listening to us, if you're doing something else, just think about it. What are you doing with your money? Because if your money's in a savings account beyond the emergency fund, you are losing. And sometimes you have to say it that bluntly to cause change.
Mm-hmm. And on that point, like you mentioned bonds, I just looked it up. So the 10-year treasury yield right now is 0.65%. So the 10-year treasury, the bonds, which are, essentially guaranteed money because, it's backed by the federal government, but over 10 years, you would earn 0.65%, not even 1%, less than 1%. If you bought a 10-year bond today, you would earn 0.65% in 10 years. And remember, and savings accounts.
That's held to maturity. That's if you hold it to maturity.
Oh, yeah, right. Yeah, I'm saying if you hold for 10, right? If you hold for 10 years, you'll make 0.65% on your money. If you take it out less time than that, you earn less money. And those are the type of rates that that checking accounts are paying. Savings accounts are paying maybe 1.5 tops. Really at a bank 2%. You make it more at a credit union or an online bank. But your money has got to be in investments that are earning you a high return: real estate, stocks, a business, something. Because we got to close this ROI gap.
Yeah, and so if you're in a bank account, so if you're in that bond fund, I don't even want you in IA. So I'm not gonna say that. I hope you come up with a change, but you got to understand you are literally throwing money away. And not only are you throwing money away, unless you are of extremely high net worth and you just need to protect your money because you're already living off passive income. If that's the case, I still don't agree, but I get it. You don't really need the money. Right. I still don't agree, but I get it. If you're really thinking, okay, but these bonds are backed by the full faith of the government, think about what bailout means. Some of these companies that you thought were, oh my gosh, in financial woes, they received bailout money. What does that mean? They were given money by the federal government. So right. Although you can't say they're backed by the full faith of, the reality is they're too big to fail. Right,
exactly. Yep. All right, so just recap. This is just showing Amazon relative to Mercado Libre, two growth stocks. Most everyone knows about Amazon, 220%. They've grown 220% the last 3 years. A lot of people didn't know about Mercado Libre, which is growing at 360% the last 3 years. And again, we're just showing that there are different degrees to growth stocks. And the big companies, Amazon, Facebook's, Microsoft, they're not the only companies out there. Mercado Libre is kind of the Amazon of Latin America. They're growing a lot quicker than Amazon. And again, here at IEA, our goal is to expose our community to stocks like this.
Oh, and real quick on the Amazon piece before we go into the S&P 500, Amazon just rolled out a platform, and this is actually a thank you to everybody listening, everybody watching. This is a huge thank you for sharing with your friends, family, and it has to come down because we just received an email from Amazon letting us know that our podcast has been approved to go into their beta test for their podcasting platform that they haven't even fully launched yet. We didn't even apply. So that's pretty cool. They came to us. We work with a podcast distribution company that represents us, put in a call to them yesterday asking, did they submit it on our behalf? Their response was literally, no, it's invitation only. If they sent that to you, you need to jump on it. Mm-hmm. So that's because of you all. Thank you for the support. Thank you for sharing this. And some of the times when we actually do these lives, it's based off of your suggestions. So again, this is less than, we haven't even been in business 4 months. To receive a letter from Amazon saying we've been pre-approved for our podcast to sit on their platform and we didn't even apply, I mean, that's huge. So Thank you. Thank you very much.
Definitely, yeah, definitely. Thank you. And it shows the message is getting across, which is the whole goal of this.
Yeah.
Okay, so now on the screen now we have a graph, again a percent change graph showing the S&P 500 versus the growth stocks within the S&P 500. So what all this is so S&P 500 of course is made up of 500 stocks, but there are different sectors and different areas within the S&P 500. Well, the ETF, so the ticker symbol for the S&P 500 growth ETF is SPYG, and then the ticker symbol for the S&P 500 is just SPY. So on the screen we have it's showing the bottom half is showing that S&P 500 over the last 3 years has grown at 37%, whereas the growth stocks within the S&P 500 have grown at 65%. So essentially what this is saying is growth stocks are outpacing the market by almost double, right? So this goes back to like the Mercado Libres, as we said, grew at 360%. Amazon did 220% over 3 years. This is where the growth is. So I would say 6 to 8 stocks out of.
I heard you pull back.
Say what?
I heard you pull back.
Yeah. I got no absolutes. But I would say, but basically what I'm trying to say is, when you're talking growth stocks, you should be talking tech stocks, right? Just to be frank. You're not going to really find as many growth stocks in like retail or things like automotive. You're going to find them mainly as tech.
You know what though? That's because of the time we're in.
Yeah, exactly.
I mean, there was a time where like anything automotive was considered a growth stock, and then there was a time where anything retail was considered a growth stock. And so, who knows what the next thing will be? But it might be pharma. But right now, yeah, and pharma actually is oftentimes considered growth as well. But go ahead.
Right. Yeah. So just what this is showing you is that the tech stocks on average are growing double the market in general, growing double the S&P 500. So I know for me, and I think even looking at Brent's picks, I say Brent actually more than me, but majority of my portfolio, and I believe the majority of my picks are tech stocks. And I know Brent's are too. Majority of Brent's picks through IA have been tech stocks. And there's a reason for that. And it's showing you here that tech stocks are where the growth is. And again, for us to close that ROI gap, we need to be in stocks that are outpacing the market. And that's what tech stocks generally do. As you see here, again, tech stocks growing at 65% of the last 3 years, whereas the S&P 500, the market in general, has grown at 37%. So tech stocks are really where the growth is.
And so for any of you all who are really, you often hear us talk about what we pick and what we buy and what we don't. It's certain, we have 3 membership levels inside of IEA, and it's community, insiders, and Panthers. Depending on which level you are, you have different access to the stocks that we pick. Leon and I are actually about to set up the IEA brokerage account. And for our brokerage account, all of the Panthers literally pretty much real time or on an ongoing weekly basis will receive updates of exactly how Leon and I trade. This is going to be, they're going to see our trades. We're going to give write-ups on why we trade, what we trade. They're going to see us as we invest in the market. For everyone who's an insider, you will receive a monthly write-up on what we bought, what we sold, why we did it. And if you choose to do something similar, totally up to you if you want to do something different. But again, we're trying to go for transparency. And we're not doing this to say, watch us win. We're doing this to say, it's going to be some hiccups in our account too. And, we're going to be a very real model to show you is no matter who you are, Warren Buffett has had horrible picks. And he's overall, though, he's a billionaire. So, what do you want to be? I'd rather be a billionaire that made a couple mistakes than watch everybody else just making comments about what they did. And also, it's to bring a familiarity to the market. Now, we're about to give you all the picks, but I just wanted to let you know that's coming because you often hear us talk about our choices and why we chose it, but you haven't seen it in action. So within the next, let's say 30 days, we should have the IEA brokerage account open and Panthers will get to see the actual snapshots of what we're doing. Insiders will get a write-up on everything we've done. So it should be pretty cool.
Yep. And then the slide 4, Brent, which was, I think, sent separately.
Yep. No.
And slide 4. So what I'm gonna start doing from now on is actually doing a kind of a recap slide. So, for just to make it easier for people to not have to always go back and say, wonder what the topics were. So that we're gonna start having this up here, which is gonna be basically our key takeaways from each podcast. So so the first point is, so the key takeaways from today are four. First one is growth stocks. They grow their sales and earnings faster than the general market or the industry. Key point that they're growing faster than the market or the industry. That's a key point. That's either sales and or revenue or profits or earnings, whatever you want to call it. They have an innovative product or service that's in high demand. Again, we're using Zoom. Things like TDoc, we said, Tesla, companies that are, and again, most of these are tech stocks we're naming. And as we said, most growth stocks today are tech stocks, but innovative product in high demand. The returns are greater than the general markets. So what that means is like their stock is going to grow typically more than the market. So as we know, the market, may not know, as what we say, the stock market generally goes 10% per year on average. So that on average, of course, means not every year is going to be 10%, but it averages out to be about 10% per year. Growth stocks will have their stocks actually grow faster than that. Their sales and profits grow faster than that as well. And as you see there, growth stocks almost double the market over the last 3 years. So that's another characteristic. The last one is they tend to be more expensive. As I said before, we measured relative expense to inexpense using the PE ratio. That's one way you can do it. There are many ways you can do it. You can use linear regression. You can use sales. You can use stuff on the balance sheet. But the easiest one to use, and the easiest one to find, frankly, is going to be PE. You can go to Yahoo Finance and find PE on any company. And remember, if you're using PE, you want your PE to be less. You want your PE to be lower. So if you have a stock that has a PE of 20, that one is cheaper than a stock that has a PE of 50. So you always want your PE.
I understand most growth stocks will have a higher PE. And
right, yeah.
Additionally, when we say low, it is a point where you get into that what's wrong with the company framework. And that's like 15 and below, really 10 and below is when you get into that, okay, I need to figure out why it's like this.
One other point on PE. So if you're looking at PEs, you'll notice that some PEs have negative PEs. And if you see that, don't be, all it means is they don't have any earnings, right? Their earnings are, or they're losing money. They're not making any money. Not necessarily a bad thing, because what you want to then default to is that you want to look at their sales. And you want to see if their sales are growing at a good rate. Because a company that doesn't have any profits, you then want to look at their sales. So if a company has a negative PE, it's not necessarily a bad thing. And a lot of times you'll see that in young tech stocks. They'll have negative PEs because, again, they don't have any profits. So you want to default to their sales and see how are their sales growing.
All right. And so with that being said, I think that brings us to the fun part of the evening, our stock picks. Is that you, man?
No, that's you.
It's funny. It's actually somebody from the live calling me.
Tell them to put the question in the comments.
That's hilarious. But anyway, so we're getting to that place where we're going to give you our stock picks. Leon, if you want to give yours first.
All right. So my pick today is, let me show you the ticker right. My pick today is I believe it's pronounced FLIR. The ticker symbol is FLIR. That's also the name of the company, FLIR Systems. Today they closed at $36.55. They were down 4.67%. I'm just gonna read what they do. So they are the world's largest company specializing in the design and production of thermal imaging cameras, components, and imaging sensors. And they just recently had their earnings and they beat Wall Street estimates, which was good. Their 2-year average profit growth is 2%. 2-year average sales growth is 1%. And their current dividend is 1.86%. Now, those three metrics for me are low. I usually, like I said, profits are 2%, sales are 1%, dividends are 1.86%. As I always say, I want a stock to have a dividend of at least 2% or more. And I want their sales and profits to be significantly higher. The reason I chose this company is because they're a solid grower. Their sales and profits are lower than my typical, but they're a solid growing company. And their pre-COVID high was $60, right? They're currently trading at 36. So I'm looking at this not as a exponential grower. I'm looking at this more as one that's going to recover over time and get back close to that $60 range. So I'm looking at like a 50% gain on this, over time. And again, we're talking, minimum 3 years, more to 5 to 10 years. If I hit my target before that, I'll make a decision. But none of this stuff Brent and I recommend is overnight. So So yeah, so it's FLIR Systems. They're a camera and imaging company. Sales and profits 2%, profits 1%, sales dividend 1.86%, and ticker symbol is FLIR. And their pre-COVID high was $60, and today they closed at 36.
And I mean, with that, I'm looking. We have the chart up right now. Going left to right, it's an upward trend up until like November, September, October 2019, but they were on their way back up. They just had a dip. They were on their way back up before COVID. So everybody has a steep slope from COVID. Steep slope from COVID. So yeah, I really like the way they're headed.
Mm-hmm. And like I said, they just reported earnings a few days ago, and they beat Wall Street estimates. The one thing they did say that they're not offering any guidance. So most companies give guidance into the future for future earnings and sales. I think like 99% of companies have discontinued guidance because they can't see the future because of COVID. So so they didn't give any guidance, but their sales, they did beat Wall Street's estimates for sales and profits.
Yeah. Also, it's going to be a lot of companies that have like inflated books because of monies they receive through some of these government assistance programs. And it's going to be interesting to see how this plays out when the audits start to happen. So let me see. But they didn't stop their dividend. So that looks promising. A lot of companies who really were in financial woes discontinued their dividend until further notice.
Right. Yeah. I mean, they weren't hit anywhere near as hard as like hospitality, hotels, and anything like that. So they're and like I said, they just beat Wall Street estimates. They made money this past quarter. So you know they're feeling the pain of COVID, but not nowhere near like hospitality.
Yeah. So twist. I picked Mercado Libre.
I do. You just picked that.
No, seriously.
There's no way you picked that.
They're doing a lot of work with eBay. And so
but wait. There's no way you picked that.
Right? No. This is totally all right. I picked Mercado Libre because Leon found it. So as a result, I looked the company up though. I did a lot of research on it. They've been partnering with bigger companies like eBay for like the last 6 years. And they've been establishing themselves not only as the company that eBay originally bought into them. The thing I really like is they bought their equity back from eBay. So that shows a very healthy, robust company. When you can buy back your position from a company that possibly was going to do a hostile takeover at one point. Now, because they're a growth company in an emerging marketplace, the sky's the limit, right? And we're talking about Central America is booming from just a population standpoint. And when you look at like how they're starting to create a lot of people in the US who want to retire and actually live a comfortable lifestyle, they're going to Central America. And the thing that a lot of people aren't talking about is hyperinflation is possible. When all this COVID stuff finishes, I really hope you all take these discussions very, very seriously. And it's one thing that Leon and I are trying to really grow the platform. It's another thing to just say this is the reality of where we're about to head. There's no way a government can give out as much money and sustain a country financially for so long and not have some serious repercussions when it's over. And if you are keeping your money in a savings account, I'm praying for you, but it's not looking good. Because when hyperinflation, if hyperinflation kicks in, the banks aren't going to increase what they're paying out in interest. They're not. And so unless you figure this game out called the stock market or real estate or entrepreneurship, whatever it might be for you, it's going to be a very real uphill battle. But with that being said, Mercado Libre is actually a really cool company. So I'm glad Leon found it. When I looked at just how they're starting to position themselves in Brazil and also Panama, they're very strong. They're very, very strong. And they're doing partnerships now with smaller companies and acquiring companies along the way, which again, normally shows a strong balance sheet when you can acquire other companies that are also doing well. So I think they have a lot of market share to get. I'm always looking at how big is the market they can serve. and they have a huge market share. Yeah, so Mercado Libre, ticker symbol is MELI. Full disclosure, Leon introduced me to the company. I will give him his credit, but I chose it.
Right. And real quick, I see the company share price is $1,111. Remember, don't let that scare anybody, because you can buy fractional shares. So you can go, if you only have $100, you can go buy $100 worth of one share and still get in Mercado Libre, as long as your broker does offer fractional shares.
Yeah. And again, I'm always about the chart left to right, right? And if you go left to right on Mercado Libre, I mean, it's they've climbed a mountain in the last, like, similar Amazon. A huge, I wish I knew the percentage, but a huge percentage of Amazon's growth has come since February. Mm-hmm. So the reality is, this is where digital e-commerce too. E-commerce is the platform to be on. You know, if you deal in e-commerce anyway, your company has a propensity to do very well in this marketplace. So, yeah, they're a great company. Ticker symbol is MELI. They are currently trading for $1,111.64. Yeah, thanks, Leon.
Yeah, no problem. I'm here for you, bro.
The company is an Argentinian company, but in being an Argentinian company, they actually incorporated in the US. So you're not buying them through an ADR, which is really cool. So yeah. Is it?
Yeah, so in recap, growth stocks, we covered that this live, this podcast. If you want to learn about value stocks, listen to our podcast from last week, which we define what value stocks are. We kind of let you know how to kind of price them using the PE. A lot of good information there. And again, this one was on growth stocks.
Yeah, and we're having fun with the net. Hold on. Is Sheila Noble watching?
Who?
Sheila Noble is watching us right now.
What? She commented?
Yes. Well, we have to say we love you, Mom.
That's my mother, by the way.
That's my mother, number 2.
Yeah, my number 2. Yeah.
We love you. Thank you for watching, listening. If you're listening to the podcast, that is Leon's mom. We just found out is watching and listening to us, and that is awesome. So look what your baby boy is doing. Trying to change the world. So with that being said, again, we want to thank everybody. The news we got from Amazon was amazing. And again, it's only because you all have been coming in, sharing these lives, listening to the podcast. We are starting to get people who are finding the Facebook group through the podcast, which again is awesome. And a number of you all have registered to our YouTube channel. So the subscriptions are ticking up regularly. And, you know, we're just going to bring you the best product we can. Thank you.
Yep.